जगह खिंचाव महसूस हुआ। मैंने दूर से तुम्हारी पृथ्वी के इतिहास को पढ़ा और
Here are two pictures. One is your locker, the other is a garbage dump in the Philippines.
Hello, welcome to the How to Read Candlesticks and Basic Patterns video. This video is going to help explain to those of you who are newer traders what a candlestick is, what that means when it prints, and how to identify very basic patterns that you will see frequently in the market. Candle reading is something that I personally love to do and many people find helpful. I will just preference this with a disclaimer before we get into the This video has been requested by you guys to go over the pros and the cons of trading with a personal account versus trading with a prop firm account. So what I'm going to do is run through the pros and cons of each of them and then kind of give my personal overview on what I feel is the best based on where you're at with your process as a trader. I myself do trade both style accounts. I still trade with prop firms. I have been with a few firms on and off throughout the years, and I also trade my own personal accounts. If you guys have ever seen any of the testimonials I post or like things I do on Instagram that I post and stuff like that, I show both versions on if you got my own personal accounts. If you guys have ever seen any of the testimonials I post or like things I do on Instagram that I post and stuff like that, I show both versions. You'll see that I will post sometimes through my prop firm accounts, and then other times I will post through my personal accounts. So it's pretty well known that I do trade both of these, which is why I am presenting this video to you guys, because I am well versed in the pros and the cons of trading with both of them. I personally have been trading for quite a while now, and I have been trading the personal accounts longer. But had I started trading now in this time, I think that the prop firms have a little bit of an edge. So I'm going to go through the pros and the cons of both, and then you guys have to decide for yourselves what personally will work best for you. This is a decision that you alone have to make, but it is nice to have somebody who has been there on both ends to present to you some of the good and the bad of both of them. Ultimately, though, it is up to you guys to decide what is best for you at this point in time and in your journey. Okay, so let's jump in with personal accounts. Let's talk about the pros that come along with trading your own personal account, meaning you're going to deposit your own personal money, your own personal capital into your broker's account, and you're going to trade with that money. So the pros of this are that there's no restrictions for monthly profits or targets. When you're trading with prop firms, there are evaluations that usually come with them, or some sort of like proof that you're a good enough trader to be consistent, profitable, and also have good risk management. So you do have to like pass a test basically, or an evaluation. There are some firms that do not require that, but you're going to pay a lot more money for them. And the kind of money where it starts to become like, well, maybe you should just trade that much money on your own because it's that high. Like I'm talking like usually 1K, 2K, maybe even I think I've seen as high as like 5K for some of them, even higher, that you're paying out of your pocket to be able to skip those evaluations and go straight to what would be considered a live account with them. When you're talking about that much money, I would say that potentially you would just look to maybe trade your own personal account, because at that point, that's a lot of capital you can trade with if you're trading small and using good risk management. So there are pros and cons to that, but the nice part is that there is no monthly profit target that you have to reach. Some firms do require that, and there are like no restrictions really when you're trading your own account. You're not stuck to all the strict rules that come along with a prop firm. Some of these rules include things like drawdown restrictions. So typically, Not all of them. Some of them will be a little bit different, but typically, on average, most firms have a 5% drawdown, a daily drawdown. So you cannot go more than 5% negative of your overall capital in your account, or you would violate a rule, you would lose that account. If you're trading your own personal account, you can go into pretty much as much drawdown as you want as long as you don't get margin called. So there is that. If you're somebody who trades heavy and you like to have higher risk, you may want to trade a personal account so that way you have that freedom to allow that drawdown. You can also trade at your own pace, meaning there's no time pressure on you to trade. With the evaluations that come along with prop firms, there are time restrictions. So you're looking usually somewhere between 30 days to 60 days to make a target profit and to reach a goal. That can suck if you're a slower trader. It can also suck for you if you are somebody who has to trade like higher time frames because of your life, or if that's just your preference. If you're a swing trader, it can be very difficult to pass some of these prop firms in the time that you're supposed to, because you may not just get a good setup during the time that you need it. But you might be able to meet those profit goals based off your swing trades, but you just don't have the perfect setup that comes along during the time when you sign up. So in cases like that, a personal account may be better because you're at your own speed, the way that you want to trade, the times you want to trade, like you have that ability to pace yourself. There are no consistency rules when you're trading on your own account. Another positive, but also could be a con, which we'll get into, but there are no consistency rules. When it comes to the prop firms, most of them have eased up a lot with their consistency rules. They were pretty vague before, but they have gotten much clearer now, where they just say you trade at your own style, whatever you want. You can interchange scalping and swing or intraday. They've gotten better with it, but that doesn't mean that there's still not some rules that are a little bit stricter than you would have if you're trading your own personal account. You can do pretty much whatever you want when you're on a personal account, as long as you don't violate margin or leverage, then you're fine. So that could be something, that you guys would want to have a little more freedom with. A huge perk, in my opinion, is that you get to keep 100% of your profits versus having to give a profit split. Another thing that you may find as a benefit for people who like to use specific brokers is that you get to pick your own broker then if you're trading on your personal account. When you're trading with a prop firm, many times you're going to be stuck having to trade with whatever broker that prop firm uses once you get your live account. So that could be something that would be a pro for trading on a personal account, is you get to stick with the broker that you like, that you've been using, maybe you've been demoing on, and that's who you're comfortable with. Lastly, a pro, and also sometimes a con, is that you can compound a lot easier because you have the no restrictions, you don't have the drawdown problems, you don't have the consistency rules. So you can compound your account. So you can do the grow a small account thing. So that is a benefit, and it is possible to do. This would fall into that 20 pip challenge thing. If you guys know what that looks like, it is on the website. So for those of you who might not know what the 20 pip challenge is yet, maybe you didn't find it on the website, if you come under the Get Smarter tab on the Trading Floor website, and then you come to the 20 pip challenge download, you can download this sheet. So we'll open it up for you and I'll show you guys. Basically what this will show you is when you're starting out, you would start at different levels. So you have all the levels you want to go through. The idea is that you would start with a $20 balance. Very low investment here, small capital. Then what you would be doing is compounding your trades. So as you trade and win a trade, you will compound and move up to each of these levels. So you would start at trade number 1 at $20, and then eventually by the time you win your 30th trade, you should have compounded your account upwards of $40,000. So you can see here, this would be where your capital would be at. This is a lot easier said than done, you guys. So definitely looks really nice here when you have it all written out, but it is much harder. People have done it. There have been people who have posted about it in the testimonials. They have shared their experience with doing it. Artie has also done this challenge. There have been a few other people who have talked about it. On average, I will say that this challenge typically takes people about 6 to 9 months from what I've heard from the people who have actually done this specific challenge. So this is not a get rich quick thing. It looks very enticing when you're looking at it. You're thinking, oh, it's only 30 trades, how easy. But it's not that simple. There is definitely a lot of pressure that you put upon yourself, especially as you start seeing some of the higher risk that you're risking. So you have to be prepared on a live account, on a real account, to potentially lose as high as $9,000 in a trade. That's huge money. That's huge, huge money, guys. So it looks like it's not a lot, but this is real money. So if you are risking that, that is a true $9,300 that you're going to be losing on that trade. $9,000 is significant money for most people. So this is something that mentally will take a little bit of a toll on your video has been requested by you guys to go over the pros and the cons of trading with a personal account, the $20 balance. Very low investment here, small capital. Then what you would be doing is compounding your trades. So as you trade and win a trade, you will compound and move up to each of these levels. So you would start at trade number 1 at $20, and then eventually by the time you win your 30th trade, you should have compounded your account upwards of $40,000. So you can see here, this would be where your capital would be at. This is a lot easier said than done, you guys. So definitely looks really nice here when you have it all written out, but it is much harder. People have done it. There have been people who have posted about it in the testimonials. They have shared their experience with doing it. Artie has also done this challenge. There have been a few other people who have talked about it. On average, I will say that this challenge typically takes people about 6 to 9 months from what I've heard from the people who have actually done this specific challenge. So this is not a get rich quick thing. It looks very enticing when you're looking at it. You're thinking, oh, it's only 30 trades, how easy. But it's not that simple. There is definitely a lot of pressure that you put upon yourself, especially as you start seeing some of the higher risk that you're risking. So you have to be prepared on a live account, on a real account, to potentially lose as high as $9,000 in a trade. That's huge money. That's huge, huge money, guys. So it looks like it's not a lot, but this is real money. So if you are risking that, that is a true $9,300 that you're going to be losing on that trade. $9,000 is significant money for most people. So this is something that mentally will take a little bit of a toll on yourself. So you have to be ready and prepared to do a challenge like this and be able to take those kind of losses. If you're interested in doing something like this, I definitely suggest you practicing a little bit on demo and practice getting used to seeing these type of trades and losses and stuff like that. I also suggest that you trade something with a higher win rate, because if you have too many losses in a row, you will blow your capital at some point and it will just destroy the challenge and you will have to restart over with your $20 again. But the idea here is that you are just starting with $20. So even if all else fails and you totally blow the account somewhere down in here and you lose all of this money, like these thousands and thousands of dollars, what people say to themselves to make themselves feel better is, well, I really only ever actually lost $20 because that's all you invested here. So there is the benefit of that. In reality, though, this is real money, so you guys could have withdrawn it. So if you get in these areas like the 8,000, 10,000, 14,000, and that's a lot of money to you, maybe just take your money. We have this whole sheet for you guys. You can download it. You can kind of put your pair, your sessions, your dates, whether it was a long or a short, whether it was a win or a loss, and kind of track along what you were doing. As you complete each level, you can click the little completed check mark and it'll complete it for you. You can make little notes about what happened with those trades, things like that. So people are drawn to the 20 pip challenge because of the fact that it's $20. It's a very cheap way to start trading, to have that live market pressure put on you, to feel like you're trading on a live, not just a demo, and then being able to potentially build up to something as high as 40,000. That's huge, and it's really good for your self-confidence to have this kind of win behind you, to feel like, oh, I can do this. Please make sure though that you're trading something with a higher win rate, you're sticking to the risk management and all of that. But yeah, there are definitely benefits to trading with a personal account here. So you can see that could work for you. So that would be the pros of having a personal account. There's a lot of them, and there's definitely some real potential to still make some money, especially if you are doing like the compounding thing with the 20 pip challenge. Potentially looking into having a personal account and trading the personal account. As for the cons that come along with a personal account, there's not too many of them, but the ones that exist are big. Like, they're big boys. The first con is that you typically are starting with a smaller account, which can be kind of hard mentally to deal with when you're making very small profits. Like, if you're only making $1 or $2 at a time, a lot of people struggle with that, especially if you're comparing yourselves. Please try not to compare yourselves. Again, easier said than done, but your journey is very different than someone else's. The point is that profit is profit. So if you're able to make consistent profit, even if it's only $1 or $2, eventually that will get scaled up and it will become higher profits. Try not to get yourselves in this like mental funk over comparing like what your profits are to someone else's. The idea is to just be winning and be consistent with your trades. Like, you just want to see consistent wins and have profit building up. Good risk management, consistent wins. Doesn't really matter how much it is, because at any point you are able to start scaling those numbers up or compounding them. The goal is to just get consistent. However, having a small account can still sometimes be a little bit frustrating. Typically, most people aren't starting off with a huge amount of capital, and I don't suggest you do. Even if you are the 1% person who has like 100K savings sitting around and you're like, I just want to like start trading my 100K savings, I highly suggest you do not do that, because the likelihood of you losing it all is pretty high. I'm not gonna lie. It's pretty high. I would start very small, just get the jitters out, get used to trading on your live account. In a personal account where you do have the freedom to go pretty high risk, and you go over the freedom to lose a lot of money. So those are the other two cons, is that you will potentially risk way too much and lose that actual money. Whereas with a prop firm, there are drawdown rules where if you violate and you lose more than that percentage that they say that you're allowed to lose, you lose the account and that is it. The difference between the personal account and the funded accounts, the prop firms, is that the personal account, if you actually violate what would be a rule and you say lose $5,000 to $10,000 on a real personal account, that's really $5,000, $10,000 that you lost. Like, it's true money you lost. On a prop firm account, you would be losing the fee it costs to start that account up, not actually losing the $5,000 to $10,000. They're absorbing that hit, and you are just going to lose the fee that it costs you to start up, which is usually somewhere between like, there's some really cheap ones now. I think there's even like some cheap like $80 ones. And then they can go up pretty high, up to like 1,000, maybe even 2,000. But typically somewhere between like the $300 to like $500 range is where most people are spending on one of these accounts, and that gives them access to higher capital. I'll talk about that when I get into the pros of them, but just so you guys understand, if you are risking too much on your personal account, you are losing all of that money. Whatever you've lost, you've lost. If you risk too much on a funded account, you're losing the fee that it costs you to start up the account. You do risk potentially over trading again, because you want to make your money back. You can't take the loss. You're just in your head and you start doing risky things. You risk over leveraging too much on a personal account. You risk margin call on a personal account. There are these risks that you're going to have to take into consideration. It will take you to be very strong mentally to be able to trade these accounts and stick to a very good risk management plan. That comes with discipline, and if you are a disciplined trader, then a personal account is probably a good way to go, because you will keep 100% of your profits. If you are a newer trader and you are lacking that discipline, you may want to look at something that has stricter rules and it has a very low risk to it. So whether that's starting extremely small with your personal account and putting only $20 in and making that it, and try to build it. If you lose it, it's okay. It was only $20. Or whether it's starting with a prop firm where you would put a fee in, and like that fee is the most that you will ever lose. I suggest if you're still starting out, you start small. Losing your actual money obviously is the other big risk. I just kind of went over that, but you lose your real money. So that really does suck too. You lose real money, whatever that loss is. Like for instance, on the 20 pip challenge sheet I showed you guys, at some point you potentially could lose up to $9,000, and you could really be losing that $9,000. So that could be a big hit to some of you if it's like an issue when it comes to money and you're just putting too much money into trading, which happens a lot. You know, a lot of people think, oh, no, I've cracked the code now. I learned this new strategy. Let me go put more money in. And oh, no, not this time. But the next time you learn a new strategy and you think you got it and you're like, this is it. Let me go put real money in. And you just kind of keep repeating this very vicious cycle of losing money, depositing money, losing money, deposit money, lose money. I suggest that if you're going to trade personal accounts and you're this person, that you really start small. Keep it $20. Start small. Don't focus on this massive end goal where you're thinking you're going to make millions of dollars all of a sudden. You're not. You're not making millions of dollars anytime soon. The goal is not to make the money. The goal is to get consistently profitable. That is all you need to do. The scaling up of the money in the account will come later. Your goal is to become consistent. That is it. To have good risk management and become consistent. That is all you need to be able to move up and scale up. The account size truly doesn't matter once you've mastered that. The account size will come later on, where you can then move up. You can either compound or scale your account. So those are the cons of the personal account. So there's not many of them, but those are some big boys that you have to worry about. And they can take a big toll on you psychologically if they go wrong. So prop firms, the pros for them, there's a lot of them as well. You have the ability to deposit a low amount of money. So you buy an account for a set amount, and that is all you're risking, is whatever your fee is that you paid for that account and that amount of capital to trade with. The reward can be quite high if you are a consistent trader and you follow the rules and do well, and you get a live account. You very well can make some very good money trading their capital. And the only risk really involved is the money that you paid for that fee for that account. There's definitely an allure to these prop firms because of that. You can only lose that fee that you signed up for. So even if you blow an account and you lose like 100K, I don't know, something crazy, 100K worth of money for them, it doesn't matter. You're never paying that 100K that you've lost. You're just going to lose the fee that it cost you to sign up for that account. You're never responsible for anything else after that. You will lose the account and have to potentially sign up for another one, but if that's all you're losing is maybe a couple of $100, that's much better than losing an actual 100K on a live account. Another pro would be that you kind of get rewarded pretty quickly as a newer trader, especially if you're a newly profitable trader. You may not have the ability to compound your accounts just yet, even like what I just showed you. Maybe your mental stuff isn't there just yet to be able to like hold those trades, or maybe you're just not interested in the compounding journey. Maybe you're looking at something that within a month or so, you could start making profits. Typically with these prop firms, if you pass the evaluations, usually within 30 days, you can start to see some sort of income coming through. Whenever their payouts are, it depends. Every firm is different. Some firms have bi-weekly payouts, some have monthly payouts, but typically after you pass the evaluation and you get your live account, usually within 2 weeks to a month of trading on that live account, you are now eligible to receive your payout, which can be good for people who are looking to make money a little bit faster than waiting to compound. So you need a very low amount of capital to get access to larger amounts. So like I kind of already explained, you may pay potentially like $500 for a fee up front for an account. The $500 will grant you access to a 100K account. So you'll pay $500 to the prop firm to get the account. They will send you the details, but when you open up the account, you will have 100K worth of buying power. So you will then have access to higher capital that you yourself may not actually have 100K to put into an account. This allows you to have that. The catch is that you have to follow their rules. They do have strict rules that you have to follow. So make sure you look into them if you're interested in doing prop firms. Really spend the time reading through their facts and their questions. Know your account style inside and out before you go and trade that account. That is important. But the strict rules can be a con and they can be a pro. As for why it's a pro in this case, it's because the strict rules are very beneficial to newer traders and learning the discipline that's required to stay consistently profitable. A lot of times there's cases where newer traders will see some sort of profit and they'll think like they're the best and they're invincible and they crack the code to trading, but they will quickly be humbled by the markets like in a month or so and realize that they have no idea what they're doing and they're not consistently profitable. They're profitable but not consistent. These rules that these prop firms give you, they really are set in place. One, to protect them, obviously, because they're investing money into you and having you do this and trade for them. But two, also to protect you as a trader, to teach you how to become disciplined and how to risk manage properly, how to trade properly, not just gamble and like risking too much or going like one day profitable and one day super negative. Like that falls into the gambling mentality, and they do not like that. They want consistent, profitable traders, even if it's like slow and low. That's more their thing than going crazy high in one day and then crazy low in another day. They don't like to see that. They like to see very slow and low traders making consistent small gains. That is more their style, and that is why they have these rules in place. So that is very helpful to newer traders sometimes to learn how to move out of that gambling mentality and into more of a strict discipline mentality. They do have strict risk management rules. This helps to ensure safe trading as well. So again, there are strict rules and there are pros and cons to this. If you are somebody whose style of trading is to be a little riskier and you go big or go home kind of style, this probably isn't going to be good for you long term because of their stricter rules when it comes to risk management. But if you are a new trader and you are looking to kind of do the low and slow and you're okay with it because you're getting access to such high capital that even making 1 to maybe 4% a month is more than enough for you because of the capital size that you have to trade with, then this is a good option for you. Having strict risk management and strict rules helps you stay consistent and profitable and will get you those nice little gains that you need to still be able to make a little bit of income on the side. Pro to this is bi-weekly or monthly payouts. So again, another pro and a con at the same time. If you're looking to compound your account and really build it, you're not taking out those profits until you reach your goal. Depending on the timeline it takes you to do something like that, if it was a personal account, like I said, most people I've heard from who have done it have said it typically takes them about 6 to 9 months to fully complete it from step 1 all the way to the final step. Some people will do it faster, some people will be slower. It all depends on you as a trader. But if you're looking to get paid more consistently, like a job would pay you, then you would be looking more like the prop firm route where you get the bi-weekly or monthly payout. And then whatever your account is like on the payday is what you will get to withdraw. So that will come out and then that will be like your payout. They'll take their percentage cut, you'll get your percentage cut, and then your account resets and you go back to trading it the way it was at the minimum capital that you started with. So for instance, say you were trading on a prop firm account and it's a bi-weekly payout, so you're getting paid every 2 weeks. Say you have a 100K account and you make $10,000 on that account in 2 weeks. Your payout day now comes up and you want to do your withdrawal. You will then ask for a $10,000 withdrawal. So you request your $10,000 to be paid out to you, and say that you're like on the second month of getting paid out. So they're going to keep 20% and you're going to keep 80%. So you'll get $8,000 paid out to you actually. They'll keep their $2,000 because they keep 20%. That's just how prop firms work. They're going to take their cut when they can, and you'll get your $8,000 paid out to you. Your account will reset to $100,000, and then you'll trade again for the next 2 weeks to get your next payout. So that's how that would work. Some people like that because it feels more like a job to them. They get every 2 week or every month, depending on your prop firm, how they pay out, will get paid versus like a personal account where you could withdraw anytime you want. So if you are a consistent trader and you're doing well, you can take money out. If you had a really great day and you're a high risk trader and you had a huge day, you would withdraw your money right there on the spot and you could do that. So that's a pro to that. The con is if you're somebody who needs to grow the capital because you don't have it, you're not going to be able to withdraw it for quite a while until you've really built that account up. So it just depends on whether you want to have something that feels more job-like, where you get paid every 2 weeks and every month, or whether you would like to have the freedom to withdraw whenever you want or continue to like grow your account however much you want. Another pro to this is that it's easier to be considered a job for contracted workers. I kind of just touched on that. But if you like the idea of having like a job type of title, you are considered a contracted worker when you work for these prop firms. When you are hired on, and I mean hired on in little air quotes because you're not officially hired, but like when you are given your contract to work with them, you're considered a contracted worker now. For those of you who are just starting off and maybe you don't keep another job, maybe you've decided to leave your job or whatever, and you have no real proof of income, and you're telling people, you're like, I like day trade for a living, and they're like, what does that even mean? Like, what's your real job though? This would help you, those of you who are in that field where you're like, how do I explain what I do? This gives you like a contracted worker status if you're going to apply for loans of some sort, or you need to apply, I don't know, wherever you live, whatever your thing is, like you want to get a car or you want to buy a house and you don't have like a way to prove your income really because you are self-employed. If you fall in this category of a day trader, it is a lot easier to claim yourself as a contracted worker and say I work for a prop firm or a professional trader, to say that than to just be like trading your own personal account and have to like prove that. There is a consistency that comes with trading with a prop firm and being able to show payouts consistently, again, every 2 weeks or every month, that like banks who would lend you loans or mortgages or whatever would look at and see like, oh, okay, this is easier for us to understand than just being like, oh, I just day trade a personal account whenever I want. That's a little harder to prove. Again, this is a very personal thing for you to think through and say like, which one works better for me to have. So the cons of trading with a prop firm. The account restrictions, such as like your daily and max drawdowns, they may feel really limiting to depending on how your style trading is. Like again, if you're a very risky trader, you might only be able to get like a couple of trades in before you would hit those limits, and like you may miss the move that you needed. So it could feel a little bit restricting to some traders and certain styles. You also have to hit monthly targets that are timed when you're in the challenge or the evaluation phase. I am not a big fan of this idea. I hate that they put a limit on your profit targets, but I understand from their point of view, you need to prove that you can be a good, successful trader. I do think that is a bit harsh, some of them, but there are firms that do go kind of low with their percentage targets. So I've seen as low as 5% for some of them. I've seen 12% at times on some of the challenges. I personally trade with my Forex funds. Their goal for their first evaluation phase 1 is 8%, and then the goal for the second is 5%. I think that's pretty reasonable. The 8% can be a little bit hard to do, but I do like that they give the free retry. So you should also look into that if you're interested. Some of the firms like FTMO will give you a free retry if you are in profit at the end of your challenge. So say that the end of your challenge comes up in 30 days and like you didn't reach this target of 8%, but you maybe are at 6%. You can ask for an extension or you can ask for a free retry and you will get another opportunity to pass it, which I think is very nice. That's actually a newer thing in the last year or two that challenges have started bringing on. And I think that that's very nice. It doesn't put as much pressure on a trader who may be a bit of a slower trader or have slower gains or maybe just a rough month. But as long as you are trading and you are at least in profit at the end of your time challenge, they will allow you to retry it, which to me can actually be a pro, but also again a con, where if you're somebody who feels really restricted by times and targets, or you tend to trade poorly because mentally it messes you up a little bit, which is understandable. Psychologically, having those restraints on your trading can be kind of hard. It may not be the best option for you then. There are multiple phases that you have to pass, and they also set a minimum day, most of them, not all of them, but most of them, where you actually, even if you pass in like day one, you actually have to wait like 10 days still, which could be a con for people who do tend to overtrade. You may be tempted to overtrade that account still and then lose it, which I have seen happen. You don't need to do that. Please don't do that. If you ever pass a challenge in the first day, which first off, congrats if you do, but if you do that in one day, the remainder of the days that you have that you need to trade that account still, you should trade on the micro lot, like the smallest lot possible, like a 0.01. You just hit a buy or a sell extremely fast and close that trade out extremely fast. Even if it's negative like $1, just close out the trade. You have now traded for that day and you're done until the next day. So do not over trade that account if you already passed it. You don't make money off of passing. You don't make more money for passing it. Just keep your account passed. So if you do pass it in 1 day or 2 days or 3 days and you have to trade the other minimum amount of days, take the smallest lot size possible, enter in one little trade quickly, exit it very quickly, and you have now traded for that day. As long as they do not have consistency rules or very loose consistency rules, that will count. If you are trading with FTMO, MyForex Funds, or E8 trading, every one of them that will work on. I personally have done it myself. I know it works. But that is a con, and like there have been times where I've seen people who don't understand that they don't have to fully trade through all 10 days if you pass too soon, and they end up blowing the account. So don't blow it if you already got it. If you have a sure winner and you like passed it that fast, don't blow your account. Just trade very, very small, tiny lots the rest of the minimum of the days. Again, there's strict rules that might not just like suit your style, and that is a con. And it's just, that's the reality for swing traders. Some of these accounts can be hard, although there are prop firms that are tailored just to swing traders, but they are not always that easy to find or the most ideal to trade when it comes to like their payouts and stuff. But do your homework, do your research, see which ones you would like if you are interested in it. But for very high risk people, almost never do these work out long term for them. So if that's your style trading, sticking to the strict rules is a big con for you. Another thing that does kind of suck about them is that they keep a portion of your profits, so it sucks to be trading with a company that takes 20% or 25%, I think even 30%. Some even keep 50% depending on your account and where you're trading. And that's huge. That's a lot of money in some cases. So that can really suck to have somebody taking your profit cuts from you, which obviously if you're trading a personal account, you keep 100% of them. So that's for you guys to decide what's best for you personally, but this is definitely a con when it comes to prop firms, is that they keep a portion of your profits. Typically, the longer you progress with a prop firm, though, they do tend to give you larger and larger percentage cuts to keep. So as you progress on with them and you prove you're more consistent, they do give you a higher percentage. Some firms do this, some firms don't. Again, check the facts and questions. They are always listed in detail on their websites for that specific firm that you may be looking to trade with. Lastly, you have to wait for payout dates. Again, a good and a bad thing. So a pro is that you do have bi-weekly or potential monthly payouts. Another bad thing is that you have to wait for them. So you could risk losing profits while you're waiting, meaning you might trade and lose the profits you made. Whereas on a personal account, if you had a good day, you are more likely to potentially withdraw that money. Whereas on a prop firm account, and when you have to still wait another week or so, you may be more likely to risk trading and lose the profits you did make. So it's a little bit different. Again, not everybody is going to fall into this category. Some of you will reach, maybe $2,000, $3,000 profits and you'll stop trading. And that is okay. You can do that and wait for your payout dates. But some of you will tend to gamble a little bit with that money and you might over trade or over risk, and then you end up losing the profits before your payout date. So that could be a con. Now that you guys have heard the pros and the cons of each of them, I've kind of explained the idea of how you would trade either personal or prop firms. I'm going to show you some examples here of how this would play out. So if you're looking here on the right-hand example that I have, this is Jay's chicken scratch. Thank you very much, Jay, for writing this up. So you will see example number 1 is going to be using our $5,000 personal trading account. So the risk for you would be that you are taking $5,000 of your own money and you are depositing it into your personal broker. So you would at most be risking $5,000. Example number 2 is going to be $5,000. Okay, so example number 2 would be the $5,000 account. That would be a funded account. That costs $49. This is like their cheapest account that they offer now. So say you buy this smallest account for $49. You are at most only ever risking $49 out of your pocket, and you'll have $5,000 to trade with. So you'll have access to up to $5,000. Example 3 is going to be using a 200K challenge account. You would then be risking $979 to buy the 200K account. And that would give you access to 200K worth of buying power. So what you'll see is that we're giving you 10-day examples in each of them, including the days that it would take to pass your prop firm challenge on both of them. And then also the same amount of time what you would have made if you were trading a personal account. So we're saying 10 days later. So 10 days later, what you'll see is 8%. So say you made the 8% goal, enough to be able to pass your accounts, your challenge accounts. So if you made 8% on your $5,000 personal account, you would have made $5,400. That would be your new total for your account. If you made 8%, that means you just passed. So 8% on your 5K account, which would mean that you just passed the account and you passed phase 1. You don't actually make profit for passing the challenges. You're just showing you could have done it and you would pass and move on to phase 2. And then same thing with the example 3 here. You would pass your challenge and if you made the 8% with them, and you would be moving on to phase 2. So we're looking at now 10 days even later than that, because there is a minimum of 10 trading days to pass these accounts. So even like I said before, if you pass in one day, you still have a minimum amount of trading days, so you have to wait. So we're showing you what it would look like. So now say it's another 10 days later. So now we are 20 days into trading this personal account. Say that we do make the 5%, enough to be able to pass what would be your evaluation 2. So say you make 5% on your personal account here, an additional 5%. So total you are now 13%. So you now are at $5,670 on your account. If you are looking at example 2, you would just pass. You made 5%, you passed phase 2. So now you're moving on to your live account. And same thing with example 3, you made 5%, you passed phase 2, you now move on to your live account. In order to get paid from your funded accounts, you have to trade that live funded account for 30 days. So you have to have 30 days where you trade, and then they will pay you it out. After the 30 days, you then go to a bi-weekly payout. But for that first month, they want to see that you can stay consistent for at least 30 days. So they make you wait 30 days. Like I said, again, there are rules, and sometimes that's a con. So you guys need to go through your accounts and make sure you understand what you would want if you traded a prop firm account. So as long as you were sticking to your strategy, you were consistent, this is what it will look like 30 days later. Say you made an additional 6%. So at the end of all of this, so it would be a total of 20 days here to pass what we're saying the challenges, and an additional 30. So you're looking at a total of 50 days. So about a month and a half it's going to take you, a little over, to get these totals. So let's look at what you would make. In example 1, where you're trading your personal capital, you invested $5,000 of your own money, you're on a personal live account, and you have now made 8%, 5%, and 6% in this total time frame. Adding all of that up, that would then bring your balance to $6,010. So that means that you have now made $1,010 on your account. Because you had $5,000 that you put in, you have a difference of $1,010 that you have profited. So that is good. You made $1,000 in around 50 days, not bad money at all. So for some of you, this looks like a very good possibility. For example 2, remember, you're only risking $49, but you're trading with a $5,000 account. You are going to pass phase 1, pass phase 2. You don't get paid for those, but you are reimbursed for the money you spent on the account. So you would get your $49 back. Plus, they do give you like a small profit percentage off of phase 2, whatever you make. So it depends on what you make, but yeah, they will give you a small amount. But regardless, say 30 days later and you've made 6% on your $5,000 account, and you've only risked $49 compared to the entire $5,000 that you would have over here. So basically what you would make here, you would have a total balance then of $5,300. So if your account is $5,000 that you're starting with and you have a ending balance of $300, it means you would have made $300 off of that account. So you guys would be able to withdraw $300 at the end of your 30 days. Plus they would reimburse you, like again I said, the fee up here. So about like $350 or so is what you would make in profit, plus whatever, I mean, you taking out your splits or whatever else that they would do. So it's not huge profit here. This is a lot of work for 50 days to be able to just make $300, but the potential now to consistently stay trading $5,000 with only ever actually risking $49 versus true $5,000 is much nicer. Remember, you had a lot more time here to accumulate these percentages, where here you were working on just passing an account. So moving forward the next month, there is a potential, if you're a consistent enough trader to make these kind of percentages, that you could potentially actually make the same amount of money in the following month to come once you don't have to worry about passing. So again, you would have to decide whether you're a strong enough trader or whether you're consistent enough to be able to do that. But taking into consideration that you're still trading the same amount of capital, it's still $5,000, but you're only risking $49 at worst case. Even if you blow the account, you'll only ever lose $49 that you actually invested versus potentially actually losing $5,000 of your own capital. Example 3, if you look at it, once again, you passed your phases. So 20 of these days is just passing. You're not getting paid anything, but you will get back that $979 that you spent to buy that account. So if you end up spending that much money, you will get it back after you pass phase 2, in addition to whatever profits you make at the 30-day payout. In this example, if you make 6% off your $200K account, you are looking at a $12,000 profit that you would be making. He should have wrote $212,000 on here, but he didn't. That's okay. But that's what you would see. Your total account would be at $212,000. The difference in the account balance would be $12,000. So you would be up $12,000. You would take your profit split plus whatever you would paid to start the account you would get back. So roughly looking at $12,000, almost $13,000. But again, they will take their percentage cut, so you would only receive your percentage cut from this balance. Some very different numbers you're looking at. You're looking at actually profiting $1,010 here, profiting about $350 here, and profiting about $12,000 to $13,000 with this added in here. All of them, though, as you can see, just depending on the size of your account, still with the same amount percentage that you're using. You're still gaining the same amount of percentage on your account. It just depends on how much capital you're actually trading with. This is where the allure of the trading with a funded account comes in, because you can get access to massive amount of capital. 200K will make you a lot of money if you can trade it versus depositing your own capital. And most people don't have 200K laying around to throw into a personal account. If you do and you are consistent, you would have the same kind of results, even better. But risking 200K of your own money is very scary when you could have bad days in a row and be down a certain percentage, whereas with you're risking their 200K and all you're ever at risk of losing is $979, no matter how bad you do on their account. The only thing you'll ever lose is your startup fee. There's a bit of a comfort there for a lot of traders, especially starting out. So newer traders tend to like to go this like funded route, knowing that they can only ever lose what they deposited in to start up the account. All right, so basically what you'll see if you're reading through this nice little thing here is that example 1 makes more than example 2, which we are showing. The main difference between those, though, is the fact that example 2, you only risked the $49 compared to the entire $5,000 account of your personal money. So if you ran into a tough stretch during that time and you lost like 10 to 12% of your account, which could be pretty bad, all you would do is simply blow your funded account and you'd lose your $49 and you would have to restart over, buy another one. Instead of being down like $500 to $600 of your personal money And that can be kind of hard to see, especially if you're having a losing streak. It can mess with you mentally. You can start making some bad decisions. You might start to revenge trade or something like that. Whereas if you're only losing $49, not so bad. Kind of sucks to lose the account, but you buy another one. And then you can see over here on your example 3 that your funded challenge, if you bought it for $200K, it would have cost you, I mean, it's significant money it would have cost you. But if you know that you're good enough to be able to pass the challenges and that you feel confident in what you're trading, you can make significantly more money trading their capital and using a funded account even after they take out their percentages. You'd still be making much more than you would have made on 500K risking your own. Again, only risking about $1,000 here versus $5,000 here, and getting much more capital to trade with versus only having 5K to trade with. So here are my final thoughts on this. That prop firms are the smarter investment. They are the lower risk, higher reward investment versus using a personal account when you are starting out as a newer trader. And if you are a newer profitable trader, meaning that you have done the work, you've done what you need to do to make sure that you're profitable, you've demoed, you've live market tested with a demo account, you tried to pass these prop firm challenges and you know you've done it, you've used the free trial versions that they offer. FTMO offers a free trial version and E8 Trading offers a free trial version. Please use them before you ever go buy an account. Try the trial versions. See if you can pass them. If you're doing really well with them and you feel like very comfortable, but you're still a newer trader and you don't have access to a lot of capital, or you're just not ready to risk your own capital yet, then by all means, the prop firms are the better option. I think that they are great. They have really developed over the years. When I started trading, they were nowhere near as good as they are now. The firms were much stricter, very hard to become a funded trader. They have really, really progressed over the years and become much more friendly to a beginner style trader, a newer trader. They've kind of geared themselves towards it. I don't suggest brand new traders go and jump into these, but I do suggest that if you are looking to get a feel for the pressure of trading, learning consistency, learning rules, learning how to stick to that, if that's something you're struggling with, having this pressure, a little bit of pressure, knowing you can't violate them, knowing you can't break it, helps to keep you a little more focused as a newer trader. It also will give you access to higher capital that you just probably do not have yet as a newer trader. You will risk less money ultimately going for one of these prop firms to gain a higher account that will help kickstart your trading journey. So it'll be a lower risk for you, potentially a higher payout for you. And then what I would suggest is that once you are profitable, use your prop firm profits to fund a personal account. I know a lot of people like to pay themselves first, and I do suggest that obviously you pay yourself first, but I would also recommend that you take some money from your profits and start putting it aside into an account and put it into a personal account. Let your capital slowly grow using your funded account profits, and then start trading your personal account. By the time you are ready to do that, you most likely have been very consistent and you have a strategy, you have rules that you're following, you have a good risk management plan now. You have become a very good trader now because the prop firms have taught you how to do that and have forced you to do that by following their rules. Once you've been consistent with the prop firm, you can now go over to your personal accounts and trade your personal account using the prop firm profits that you've made. That way you're never really coming out of your pockets. You're just coming out of your profits and you're just shifting them from one account to another and using those profits from that account to build a personal account. Trade your personal account the same way you trade your funded account. The same rules, the same strategy, the same risk management. Trade it the same way. That way you know you'll be profitable still. You're not over risking, you're not over leveraging, you're not gambling or doing anything crazy. You now have the rules and the consistency to trade your personal account well. And then you now get to have 100% of your profits, and you get to have all the freedom that you would want that comes with trading with the broker of your choice. And like, these are things that you get to pick now. You can still trade your funded accounts on the side. Like I said, there are perks to having like a steady job like thing, or, having something on paper to show that you work. I'm doing air quotes, none of you can see that. But, the whole work idea, or having a job, or having consistent income coming through. You could still continue to trade with your prop firms, make a couple of percentage every month just to have some sort of income coming in. But then you could also trade your personal accounts as well. And that is the goal, is use the prop firms to your advantage, get the money you would need as you're starting off, learn the rules, learn the discipline you need, keep low risk, take that money you make once you become profitable, start using it to fund your personal accounts. Trade your personal accounts then and keep the 100%, but make sure you're staying consistent like you would be with your prop firms. That is my personal suggestion. That is what I have personally done. My journey was a little different. The prop firms, like I had already just said, weren't really the best choices when I started trading, so I actually had to grow. I had to do like a 20 pip challenge type of version. It wasn't that exact challenge, but it was a version of that where I had to grow my own capital from smaller investments. That took time. It took me a good year and a half or so. If I had these options for prop firms, what exists now when I had started trading, I absolutely would have been a prop firm trader. I, to this day, am a prop firm trader, and I do exactly what I said. I take my profits, I use a small portion I will pay out to myself, but most of that has gone into funding other personal accounts, so that way I can trade them. As you become more experienced, there is the potential to link your accounts. That will copy trade from your personal account to your funded account, or vice versa. And then you only have to trade on one account, and then the other account will copy that trade and take the same exact trade. So you could, in theory, if you did something like this, you could be doubling your profits and only having to place one trade. It's extremely risky, and I don't recommend anybody does this until they have been consistently profitable for quite a while. But there is the potential to do that, because I know when I tell you guys to manage multiple accounts, your heads explode. There is ways to manage your accounts where they will copy trade each other. It will do it for you. So when you guys are ready for that, you can always ask us in the community if you get to that point and you want to know more about how you can copy your trades over from one account to another account that you own. But please don't ask us until you have been like very consistently profitable, because it's just a mess and you will blow both accounts. That is not until you are far down the road. But the idea is to take steps and progress there. And my suggestion would be start with a prop firm or a 20 pip challenge, whichever one you want to do. Start with something low like that, very low risk, and work yourself up to a higher reward. Then once you are at that higher reward, use profits from those rewards to fund your personal account to trade with using a higher capital. Only trade that higher capital once you are consistent, once you have a good risk management plan, and once you have a good set of rules and you are disciplined. You will know when you are disciplined because you have now been profitable for a while. You will start to feel more comfortable in your trading. Until you get to that point, you have no business trading high capital personal accounts. You will only get yourself in trouble. So please, please proceed with caution when you are going to fund these personal accounts. Okay, guys, so that is the pros and cons of the prop firms versus personal accounts. It is ultimately going to be your decision to make. If you guys have questions about specific prop firms that we like, that we believe are trustworthy, that we personally use, feel free to ask us in the Discord. A lot of us do use prop firm accounts, and everyone uses personal accounts that is a big banker or a admin. All of us trade on a personal account, at least, if not have a personal account and a prop firm account. So somebody will be able to help you guys over there if you have questions about this and are still a little unsure about what's the best way for you to go. Thanks for watching this. I appreciate you guys listening to me rant about both of them, and I will see you guys in the Discord. the course, that candle reading alone, I do not think is enough for you guys to trade solely off of. Hello, welcome to the How to Read Candlesticks and Basic Patterns video. This video is going to help explain to those of you who are newer traders what a candlestick is, what that means when it prints, and how to identify very basic patterns that you will see frequently in the market. Candle reading is something that I personally love to do and many people find helpful. I will just preference this with a disclaimer before we get into the course that candle reading alone I do not think is enough for you guys to trade solely off of. There are people who do it, but as a beginner I would look to use that as a confluence and not the sole reason as to why you would enter into a trade. So please be careful when you are taking these trades. Don't just see one pattern and think that that's enough to enter in. You would want to see the pattern or a specific style candle, and then also another confluence that would help to strengthen the analysis as to why you would enter into that trade. So for those of you who are brand new to trading, most people use the Japanese candlesticks, which are formed by time. Each candle is formed by a set time. So when you see things like 1 minute, 3 minute, 5 minute, 15 minute, 1 hour, 4 hour, daily, those time frames that you're seeing on your chart, when you are clicking on one of those time frames, so say hypothetically we clicked on the 5 minute time frame, that would mean that each candle that prints is 5 minutes worth of time. It took 5 minutes for that candle to completely form from open to close. You will most likely see red and green candles on your charts when you're beginning. You don't, unless you change the colors of them. That is optional for you to do as you get more advanced. But to start, you will see red and green candles. When you are looking at a green candle, a solid green candle, like the one here on the screen, that would mean that this is a bullish candle. That means there are buyers in the market and the market is looking to push up in price. When you see a strong red candle, like the one on the screen here to the right, that would be considered a bearish candle. When you see a bearish candle, that means that selling pressure is now in the market and that the price has come down. So just remember, green is buying and red is selling when you see those kind of candles. Green means bullish, red means bearish. Basically what this means is that the bullish candle shows that the price has increased over the period of time that it has been forming. That would mean that in this example of this candle, over the course of 5 minutes, the price has increased if it closes green. Opposite would be bearish, so the candle would show red, and that would mean that the price has decreased over that period of time. There are a couple of different parts to identify on candles. Most important part that you guys need to understand as beginners is what we refer to as the real body. That's the fat rectangular part of the candle that you guys are seeing here on the screen. This is known as the real body. The real body is formed as price is moving during that designated time period. So from where the price opens and closes. So how you'll see this will work is that in a bullish example, in the green candle example, price is opening down below. So if you look down in this area here where my cursor is pointing over, price is opening down here. Then price is bouncing all around up and down throughout, let's say, a 5 minute time period. Let's say we're looking at a 5 minute chart. So this would take 5 minutes to form this candle. Price during that 5 minutes is kind of up and down, up and down, up and down. And it pushes up price. Then at the end of the 5 minutes, price closes up here. This forms a bullish candle. Price started at a lower price and closes at a higher price. That is how it forms on the real body. So it opens here, closes here. That is how you identify what is the real body of a candle. Where did price open and where did price close at? And then all in between is the price where market has been moving, where it's formed this body. It would be the opposite for a bearish candle over here on the right. Opening price would be at a higher price and it would be closing at a lower price. So it opens up here, and then all along the time frame while the candle is forming, it is moving, and then closes at this price, all while forming the body of the candle. What you guys will also see as part of many candles when you're looking at your charts is what we call wicks. Some people will call them shadows or tails. You may hear it referred to as that way, but for purposes of us and our community here in the trading floor, we refer to them as wicks. You will most likely see these little lines sticking out of the real bodies of all different sizes and lengths. These are your wicks. What these are identifying is the highest price during that time period that candle had gone to. So what that means is that price opened here at the body. So remember our real body, price opened here, started to form, pushed up, all during that time frame where it's forming, pushes up even higher up here, but then got pushed down. There was selling pressure, pushes it back down, maybe came back down this way, kind of formed this, tested this price area, pushed back up, pushes back up, closes here at the end of the time frame. When the timer runs out for this candle's time frame, this is where the price closed. Opened here, closed here, tested all of these different price areas that it wicked to up here and wicked to down here, but it did not open at those areas and it did not close at those areas. So that just means that this is the highest price during the period of time where the market had pushed that price to, but it did not actually close at that area. Pressure came in from other sellers and pushes it back down. And the same thing down here. This is the lowest price during that period of time where pressure was being pushed to push the price back up. So when looking at wicks, basically it is important to understand what they mean right now. There is a way to wick read as well, and there are more advanced things that we can get into later on with you guys once you're into the Discord and further through the content. As far as identifying them and understanding what they mean, they basically mean that the market has reached those price points, but there was a rejection at some point of that price to push it down. So although the candles went to that price, they never actually opened or closed at that price. You can see here on the bearish candle, this is also another example with some smaller wicks. This is the highest point that price reached during that time period, and then the lowest point. But once again, price opened here at the actual body formation of the candle and then closed down here at the bottom of the body formation. Just to show you guys one more time, like the basics of what I just discussed there, the real body, those are the actual opening and closing prices. If it is bullish, you are opening low and closing high. If it is bearish, you are opening high and closing low. And the wicks that you will see coming off of the candles that will come out of each end, those are just testing of price areas, but not the official open and close. So besides seeing a bullish or a bearish candle, the other candle that you will identify on a chart quite frequently is a doji candle. Doji candles are just kind of like neutral candles. There are dojis that mean a lot of things. There's lots of different types. You can get into an entire doji candle reading course. But to keep this simplified, when you see dojis, most of the time they will identify a neutral type of trend, potentially a reversal in some situations. I will show you that in a couple of slides where you would identify them as like a reversal symbol. But the overall concept of seeing dojis is kind of a neutral idea. Basically what it means is that the price has opened and closed at the same or very near to the same price, and there is very little body. So there's not enough body to really decide whether it was a bullish or a bearish candle. It's just kind of neutral. That means the selling pressure and the buying pressure were about equal to one another. So as you can see here on this example I'm hovering over, it's about the middle where this candle would have opened and closed, and just wicks on each side, meaning that the buying pressure that to push it up was closed out of around halfway, and the selling pressure to push it down was met about halfway with the buyers, and it just kind of closes about equal. On the right here, you can see this one has a massively long wick, but then closes out at the bottom. This is something that you will learn a little bit more about as you get further into the community with us and with myself as well, like reading rejection wicks. This would be something you could identify as that candle reading alone, I do not think is enough for you guys to trade solely off of. There are people who do it, but as a beginner, I would look to use that as a confluence and not the sole reason as to why you would enter into a trade. So please be careful when you are taking these trades. Don't just see one pattern and think that that's enough to enter in. You would want to see the pattern or a specific style candle, and then also another confluence that would help to strengthen the analysis as to why you would enter into that trade. So for those of you who are brand new to trading, most people use the Japanese candlesticks, which are formed by time. Each candle is formed by a set time. So when you see things like 1 minute, 3 minute, 5 minute, 15 minute, 1 hour, 4 hour, daily, those time frames that you're seeing on your chart, when you are clicking on one of those time frames, so say hypothetically we clicked on the 5 minute time frame, that would mean that each candle that prints is 5 minutes worth of time. It took 5 minutes for that candle to completely form from open to close. You will most likely see red and green candles on your charts when you're beginning. You don't, unless you change the colors of them. That is optional for you to do as you get more advanced. But to start, you will see red and green candles. When you are looking at a green candle, a solid green candle, like the one here on the screen, that would mean that this is a bullish candle. That means there are buyers in the market and the market is looking to push up in price. When you see a strong red candle, like the one on the screen here to the right, that would be considered a bearish candle. When you see a bearish candle, that means that selling pressure is now in the market and that the price has come down. So just remember, green is buying and red is selling when you see those kind of candles. Green means bullish, red means bearish. Basically, what this means is that the bullish candle shows that the price has increased over the period of time that it has been forming. That would mean that in this example of this candle, over the course of 5 minutes, the price has increased if it closes green. Opposite would be bearish, so the candle would show red, and that would mean that the price has decreased over that period of time. There are a couple of different parts to identify on candles. Most important part that you guys need to understand as beginners is what we refer to as the real body. That's the fat rectangular part of the candle that you guys are seeing here on the screen. This is known as the real body. The real body is formed as price is moving during that designated time period. So from where the price opens and closes. So how you'll see this will work is that in a bullish example, in the green candle example, price is opening down below. So if you look down in this area here where my cursor is pointing over, price is opening down here. Then price is bouncing all around up and down throughout, let's say, a 5 minute time period. Let's say we're looking at a 5 minute chart. So this would take 5 minutes to form this candle. Price during that 5 minutes is kind of up and down, up and down, up and down. And it pushes up price. Then at the end of the 5 minutes, price closes up here. This forms a bullish candle. Price started at a lower price and closes at a higher price. That is how it forms on the real body. So it opens here, closes here. That is how you identify what is the real body of a candle. Where did price open and where did price close at? And then all in between is the price where a market has been moving, where it's formed this body. It would be the opposite for a bearish candle over here on the right. opening price would be at a higher price and it would be closing at a lower price. So it opens up here, and then all along the time frame while the candle is forming, it is moving, and then closes at this price, all while forming the body of the candle. What you guys will also see as part of many candles when you're looking at your charts is what we call wicks. Some people will call them shadows or tails. You may hear it referred to as that way, but for purposes of us and our community here in the trading floor, we refer to them as wicks. You will most likely see these little lines sticking out of the real bodies of all different sizes and lengths. These are your wicks. What these are identifying is the highest price during that time period that candle had gone to. So what that means is that price opened here at the body. So remember our real body, price opened here, started to form, pushed up, all during that time frame where it's forming, pushes up even higher up here, but then got pushed down. There was selling pressure, pushes it back down, maybe came back down this way, kind of formed this, tested this price area, pushed back up, pushes back up, closes here at the end of the time frame. When the timer runs out for this candle's time frame, this is where the price closed. Opened here, closed here, tested all of these different price areas that it wicked to up here and wicked to down here, but it did not open at those areas and it did not close at those areas. So that just means that this is the highest price during the period of time where the market had pushed that price to, but it did not actually close at that area. Pressure came in from other sellers and pushes it back down. And the same thing down here. This is the lowest price during that period of time where pressure was being pushed to push the price back up. So when looking at wicks, basically it is important to understand what they mean right now. There is a way to wick read as well, and there are more advanced things that we can get into later on with you guys once you're into the Discord and further through the content. As far as identifying them and understanding what they mean, they basically mean that the market has reached those price points, but there was a rejection at some point of that price to push it down. So although the candles went to that price, they never actually opened or closed at that price. You can see here on the bearish candle, this is also another example with some smaller wicks. This is the highest point that price reached during that time period, and then the lowest point. But once again, price opened here at the actual body formation of the candle and then closed down here at the bottom of the body formation. Just to show you guys one more time, like the basics of what I just discussed there, the real body, those are the actual opening and closing prices. If it is bullish, you are opening low and closing high. If it is bearish, you are opening high and closing low. And the wicks that you will see coming off of the candles that will come out of each end, those are just testing of price areas, but not the official open and close. So besides seeing a bullish or a bearish candle, the other candle that you will identify on a chart quite frequently is a doji candle. Doji candles are just kind of like neutral candles. There are dojis that mean a lot of things. There's lots of different types. You can get into an entire doji candle reading course. But to keep this simplified, when you see dojis, most of the time they will identify a neutral type of trend, potentially a reversal in some situations. I will show you that in a couple of slides where you would identify them as like a reversal symbol. But the overall concept of seeing dojis is kind of a neutral idea. Basically what it means is that the price has opened and closed at the same or very near to the same price, and there is very little body. So there's not enough body to really decide whether it was a bullish or a bearish candle. It's just kind of neutral. That means the selling pressure and the buying pressure were about equal to one another. So as you can see here on this example I'm hovering over, it's about the middle where this candle would have opened and closed, and just wicks on each side, meaning that the buying pressure that to push it up was closed out around halfway, and the selling pressure to push it down was met about halfway with the buyers, and it just kind of closes about equal. On the right here, you can see this one has a massively long wick, but then closes out at the bottom. This is something that you will learn a little bit more about as you get further into the community with us and with myself as well, like reading rejection wicks. This would be something you could identify as a massive push up by buyers. They really tried to push the price up, but the bearish marker, the sellers came in and said no and pushed it way back down. And it closes at the bottom here, meaning that the bears had enough say to make this a massive rejection wick, rejecting all the different price points that happen along the way here. So this could be something that if you saw, you would say, wow, that's a big rejection wick. Potentially the bears have taken over enough strength to push the market down because it closes at the bottom. If it was reverse and it had closed at the top here and it was just a long wick here and at the top was a little close, then you could be looking at a potential reversal where you would look to buy. That is a little more advanced, and I don't want to over confuse you guys, just showing you guys the example of dojis and that there are different types. There's plenty of different dojis you can find, and overall concept of a doji when you see them is they're just kind of inconclusive, and you would wait probably one candle or two candles after to get a sense of what is happening truly, because the dojis could go either way. They're neutral. So I just kind of ran over quickly why they could be neutral, but to give you guys a little bit of a better understanding that a doji is a candlestick pattern that looks like a cross, and it can cross at any point in that wick as long as the opening price and the closing price are equal or almost the same. And when they are looked at in isolation, a doji indicates that neither a buyer or a seller are gaining. It's just a sign of indecision. So this is where I said you would want to wait one, maybe two candles later to decide who is actually taking control of that market. Seeing just one of these wouldn't be enough for you to solely enter a trade. So these are some examples to show you dojis and why you wouldn't be taking them. You may see your doji close with a green or a red type of color in the body. That doesn't necessarily mean that they actually have control. So if it is green, it does not mean that the bulls actually have control and that they are buying. And if it is a little bit of red, it doesn't necessarily mean that the bears have control and that they are about to sell. Once again, it is a symbol of neutralness. So just tread with caution. When their bullish dojis print wicks like you see here, it just means that the candle closes in favor of the buyers, but very slightly. And you can see with the bearish doji, it means that the candle closes in favor of the sellers, but also again, very slightly. When you compare these two candles next to one another, they are equal as far as their size and their wicks. And there is really nothing here if they printed back to back that would tell me to go one way or another. This is why you would want to wait a couple more candles afterwards to identify who truly has control. Okay, so I just explained to you guys the three basic candles you'll see. You'll see a bullish candle, the green ones. You will see a bearish candle, red ones. Or you will see a doji, a neutral sign of indecision where it's just kind of a lot of wicks and a very small crossing body. Now that you understand those three, it's important to understand the very basic chart patterns that they can form and what do those patterns mean when you see them. There are tons and tons of candlestick patterns. You will drive yourselves insane trying to memorize them all. But I'm going to go through a few of the most common ones that when you see them, they are well tested, they are well proven that they work. And when you see them, you should go like, oh, that's this pattern. And you should be interested in looking at finding another confluence to trade in the correct direction with that candle pattern. So I'm going to show you first the bullish common patterns that we will see. Then I will show you bearish, then I will show you neutral ones. So that way you can kind of keep them separated in your head. So after the market has done a bearish move, meaning it has fallen, price has fallen down, it is common to start seeing bullish candlestick patterns start to form because the market can only trend in one direction for so long. So I'm going to show you some of these bullish candlestick patterns that are pretty common and that will be easy for you to spot in the market. Bullish engulfing is a very simple candle pattern. This is identified by two candles side by side. You can see them circled there on the bottom. It would entail having one smaller bearish candle and one engulfing stronger bullish candle. So as you can see, the green candle is engulfing the smaller bearish candle. This will happen after a strong downtrend. So as you can see, the market has fallen, and these are bigger candles showing good strength in the market. Then you're getting some pushback here by buyers. You get another little push down by the sellers and a smaller candle here for the sellers. This candle is signaling that momentum and strength in that direction is starting to slow down, and then it is met by a strong engulfing candle of the opposite, meaning that the buyers have now engulfed what the sellers are doing and are looking to push the price back up. So this would be a pattern that would be common to see when you are looking for a potential buy after seeing a selling market. Another common bullish candlestick pattern would be the hammer. I touched on this quickly when I was talking about wicks, but again, you would see a strong bearish market falling down, then starting to see some dying of momentum, and one last strong push by the bears, which would be this wick, where they were pushing that price down, trying to push, but the bullish market, the buyers, said no way, and that's what creates this wick. They have the actual candle closed here when we're talking about the real body of the candle, meaning that all of this wick that was formed was all a giant rejection of every single price that would have been all along here. So the buyers have now stepped in, said that is enough, bears, like that's enough, too far down with the price. They're stepping in, rejecting all of these price points and getting ready to help push the price back up. So that would be a hammer. An inverse hammer is the opposite of what I just showed you. So a strong wick at the top, but it would be followed with 3 candles. So instead of just one candle, you're going to see 3, where you will see a bearish candle that forms, pushing price down, creates a hammer here where they did try to, again, the sellers are trying to push down, but the buyers were like, nope. And they tried to push up, and the bears and buyers are basically just fighting all along this wick here. But the idea is that it does still close as a bullish now candle, meaning buyers have taken control, and then they will form this third candle, which helps to create the entire inverse hammer pattern. And this third candle is what we see as a strong bullish candle, and they are now going to look to potentially take over the market. A bullish piercing pattern is another common one that you will see. Basically what you will have is a strong bearish candle pushing down, and then the next candle will come up and fill 50% of that previous candle. And when it fills to at least 50% of that previous candle, and the gap that it leaves between the first candle and the next candle is smaller than what the candle has filled of the previous candle, this can be considered a piercing pattern. So basically what this is showing is that when the bears came in, they were trying to push this candle down. The sellers wanted the price down, and they were able to, on the next candle, push the price down a little bit more. But when it came to actually getting the price down, it did not happen. The bulls, the buyers, then stepped in at this point when price was gapping in here and said no way, and they decided to push this price up even stronger, and it covering more than 50% of that previous strong candle from the bears, meaning that they have now gained enough strength and momentum to potentially push the market in a reversal. Morningstar is a pattern that I find a lot of people really like this Morningstar pattern. However, it does take quite a few candles for it to form, which I think is why it is quite popular when it comes to identifying this. It's multiple candles giving you that stronger confluence, and it is a little bit easier to spot. Essentially what you're having with a Morningstar pattern is that the bears have dropped the market. As you can see, the market drops down, and then you get a very tiny candle here, similar to almost like a doji-like candle where there isn't much happening as far as the body goes. It's a very small body showing very low momentum. Even though there was some strong movements before, usually this is like you've just gone too far, too much, and the buyers are now saying, no way. they will meet it with a strong candle pushing back up. So almost engulfing, but not quite. It's a little bit stronger than an engulfing candle at this point. So that is what you're seeing here. So at this point, you would assume that the direction is potentially going to reverse and the buyers will take control of the market. 3 white soldiers is a common pattern you'll see. 3 really strong bullish candles all in a row. So you have a fall of the market here and a downtrend. 3 very strong bullish candles. There is no pushback at all from the bearish market. You can see everyone is strong green and closing with very little wick, meaning that the buyers were very convinced in forming that price. The real body is strong and no rejection of price anywhere with wicks, really. That's 3 white soldiers, and that is showing a very strong push and change in momentum and volume in a opposite direction. Tweezer bottom is another thing you will see, where you will have 2 of the opposing color candles next to one another. So in this example for a bullish, you would be looking at a bearish strong candle, hits the same price point here, and then opening of the bullish candle is at where the close was of the bearish opening, and then it literally matches it in size and strength and will close about the same. They usually equal one another as far as opening and closing price, and the wicks, if they do have them, will test the same price area. So it's like twins. You know, a bear is pushing down and then the bulls come in and say, nope, not happening. We are matching you and we are here and present. So this would be something where you would also potentially look for a reversal. And lastly, the bullish pin bar is something that you will see a lot. Also similar to having a very strong rejection wick. As you can see here, the tail is 2 times the length of the real body. That means that the rejection that they tried to push. So the bears are trying to push, sell price. And the bulls said, heck no, like we are pushing you up, like absolutely not going that low. And they end up letting it close very small, the body. So lots of pressure and indecision happening here while this wick is forming. And that is a big sign when you have a rejection wick of all of these price points that potentially a reversal is coming. So a pin bar could also signal a potential bullish reversal. So now I'm going to show you guys common bearish candlestick patterns, meaning that the market is potentially about to start selling off, that the bears will take over control, and the patterns that you would see commonly happening prior to a bearish market starting. Like the bullish engulfing candle, there is a bearish engulfing candle. Essentially what that means is that you would have pressure from buyers pushing it up, and then you would have a kind of consolidation period where you can see that the momentum in the candles, the strength of them, starts to fade off. You would have a bullish candle, so this candle closes as a bullish candle here. A little bit of a push from them to try, but then the bears come in very strongly and engulf this previous bullish candle. So this would create the bearish engulfing candle. As you can see, there's so much strength and momentum in this bearish candle, showing that the bears have now arrived and are ready to go and push this market down. A lot of times what you will see is it will break the area of consolidation. As you can see where all of these candles are kind of hovering at, usually the engulfing candle will break through that area as well and start pushing the market down. So this could be a potential key to looking at a reversal market or a bearish market coming after a bullish uptrend. The hanging man is essentially the opposite of what you have seen when it came to a bullish market. It kind of looks like the inverted hammer. So this would be where you are having, again, a strong uptrend in the market. The bulls are trying to push the market up. And the bears, you can see where this wick is forming, lots of pressure from sellers coming in. This is basically showing that the bulls are still trying to rally. They're still trying to keep control and gain it, but there is a lot of pressure coming through from the bears in this rejection wick. This will signal to a lot of traders who are interested in getting in at a better price or potentially getting in early on in a reversal that they may start being a lot of pressure coming in now from the bears. So people will look for this candle and jump in quickly sometimes. This could be a potential direction change if you saw this candle. A shooting star is where you will have a lot of pressure coming up. They shoot the price up. So think of it like market is shooting up. The bulls are pushing really, really hard with this, and the bears come in and say, absolutely not. They are rejecting this all along in this price, and they create basically what looks like an inverse hammer situation. So you would have this little body that closes down here, and it would close bearish, showing that the bears have now said absolutely not, rejected all of this price point, and have decided to close here, showing that the bulls have very little control and the bears are about to step in. Evening star is the opposite of morning star. Morning star, think of it like the market may potentially go up because in the morning the sun goes up. That's how I like to think of it, and the sun is a star. An evening star, the market may potentially go down, and in the evening, the sun goes down. So that's how I try to keep them straight in my head. Maybe that'll help you guys. Evening star is a 3-candle pattern that you will see, the opposite of what the morning star is. You will have a strong uptrend. You will have a strong bullish candle. Then you will have a strong bearish candle. Sandwiched between those two will almost be like a neutral looking doji style candle where you can see a lot of indecision, which is what you're seeing with this candle. It pushed up, it pushed down, not very clear as to who actually has control of the market. And usually this will happen at like a key area of where price kind of is meeting some sort of resistance sometimes. So if you see it hitting a key area of resistance and you see a evening star pattern form, you would potentially be looking to take a sell or a bearish trend to start forming. Like we saw on the bullish side, there was a piercing pattern. There is also a bearish piercing pattern. Same concept here, but flipped. So you would have a strong bullish candle that prints, and then it is met with an extremely strong bearish candle that is accounting for 50% of that movement that the previous candle made from the opposite market, meaning that the buyers were pushing the price up very strong, but the sellers came in and said, no way. They had been able to push the price back down at least 50% or more of what the buyers were able to accomplish. So if you see this, that would be a signal potentially that a reversal is coming, and just showing that basically the gap would also be less than what they were able to cover. So where the market price closed here and was able to push up and gap up, this gap in between the two is less than what the progress of what the bears had made in dropping the price. So if the gap is smaller, as well as it accounts for more than 50% of the previous candle, you would be looking at a bearish piercing pattern and potentially look for sells. 3 black crows is the opposite of the 3 white soldiers. So you would look for this pattern after a uptrend. You would see it form when you have 3 strong bearish candles, all opening and closing at a lower price than the previous candle. So you can see you have a strong bearish candle, closes here. The next one opens at that price, closes lower with no retracement. Again, price is here, it is closing at this point, and this candle is opening, very little retracement of this wick, and closes all the way down here. Lots of strength, lots of momentum. That is what that is signaling. This could signify a potential reversal, just showing a massive momentum and strength in the opposite direction now. Tweezer bumps you will see happen often at a point of resistance. So you will see a bullish trend, pushing up, pushing up, pushing up, hitting most likely a key level of resistance or price. So those of you who like support and resistance or price action trading or zones, you could look for some sort of tweezer top or bottom happening at a key level. Basically, the twin concept again happens here, where you would have a tweezer top formed after a bullish trend. It is saying that the bulls are pushing up, hitting a key level, and the bears are like, absolutely not. Too close to this key level, too expensive. We already know this price doesn't work. And they come in and say, we're going to sell. We want to sell at this area. When it hits that price, we know it's too much. We want to put in the selling pressure. So they meet it with an equal candle of equal strength, equal volume, showing very equal presence of them in the market. And at a key level, that could be a potential reversal that you would see happening, showing they're aware what's going on, they're present now, and they're going to drop that price. There are pin bars that happen for bearish markets as well. So like we saw in the bullish version, it would be an extremely long wick, at least 2 times. So the tail, the wick or tail, would be 2 times the size of the actual body, showing massive rejection. So showing super strength from the bulls trying to push. So at some point they got the price this high, but extreme rejection from the bears saying absolutely not happening. So when you see this, you could also potentially assume that the bears are well aware that this price isn't going to work and they want to push down and they are now interested. Many times after a pin bar like this, you will find you will get a strong bearish candle that will form, and that is your key to then get in. So now I'm going to show you guys a couple of common continuation candlestick patterns. The idea of these are they kind of fall into this like neutral zone, and if they're neutral candles, it doesn't mean you need to look for a reversal or you need to close out your trades. Sometimes they're just signaling that you're kind of like in an area of consolidation, or that the pattern will continue on because there's no definitive direction right now. So don't panic and close your trades. You can still hold your trade. So what you'll see here is the dojis. Like I said, the doji has a couple of different ways it can be identified. The overall concept of dojis is that they are a neutral candle typically. However, there are cases where the dojis kind of look more like those hammers or inversed hammers, like I was showing you guys, almost like a pin bar even. So in those cases, as you can see on the outer red and green candle dojis here that look similar to the hammer and the pin bar that I showed, those would not be considered continuation candles. Those could be considered potential reversal candles in the right situation. However, the dojis that are in the middle, where you have more of a cross-like figure, where it is similar wicks on each end and the bodies are small and they are in the middle, those would be considered continuation, where they're neutral. The buyers and the sellers are kind of closing around the same place. There's no real strength decided in either of these candles, so you wouldn't really care about those. If those printed, you could look to continue trading in the same direction if a doji prints like that. If one of the dojis on the outer circle print, you would look at those as a potential issue and you would want to think about where would they fit in one of those bullish or bearish patterns that I showed you. Spinning tops is another potential that you will see for a continuation. They do kind of look like tops, like the little toys. And you can see, once again, a very neutral candle. Closes in the middle. The wicks are about the same length from the top and the bottom. And there's no real decision as to who has actual control here. The bears and the bulls are meeting in the middle, and they're about the same when it comes to strength. So if you were in a trade and you saw something like this print, it wouldn't mean that you need to stress about a rejection wick or anything like that. It is equally rejecting on both ends. So you could continue to hold your trade with a candle like this. The falling 3 method, also sometimes called the 3-line strike, is something that very commonly gets confused when it comes to 3 black crows or the 3 white soldiers. So please make sure that you are paying attention to this if you plan to trade that pattern. The falling 3 is different. It is 3 very strong candles of the same color in the opposite direction. However, they do not surpass the previous strength of the overall trend. So let me explain this. You have a falling market here. You have a strong bearish candle. Then you have 3 bullish candles that are trying to push up. But they are not opening and closing above one another. They are pushing up, and they did not surpass the previous candle. They did not overtake this price. They are retracing this massive move. So the bulls are coming in to make some accountability for how fast this price dropped by the bears. But they did not overtake the price by beating the price here. They did not show super momentum by opening and closing above one another like we did with the 3 black crows and the 3 white soldiers. They did not overtake the progress that the bears have made. So don't get yourselves confused with this. This is just a small retracement to get the price a little bit higher, and then more bears become interested because they can now buy in at a better price and drop it again. So instead of having to buy in low down here and missing this whole movement, the bulls will push the price a little bit to try and rally it a bit. They fail to do it, and the rest of the bears that missed this drop are very interested now. They will come in and drop that price. So this is something you guys should be cautious of. If you're confused by the falling three method, please don't worry about it until you're a little more advanced with it. But this is also referred to, I think, by Artie as the 3-line strike that he likes. So it can be deadly if done right. You can get in at a great price, but please be cautious with it and do not confuse it with the 3 black crows or the 3 white soldiers. The rising 3 is the opposite. That would be if you're looking at it from a bullish trend point of view. So meaning the market is going up, the bulls are in the market, they're pushing it up. And then again, you have 3 strong bearish candles. They fail to overtake the progress though. They never go below the progress of what the bulls have done. And the opening and closing prices aren't quite as strong as they would need to be a 3 black crow or a 3 white soldier. And you can see they just retracing this bigger movement, get you in at a better price so you can buy a little bit lower now. And all the people who want to buy are always looking for a sale. They're like, cool, the price just went on sale. And they get the price they want here and push the market back up. Okay, so you guys have become candle connoisseurs now. You have finished this course with candle reading and knowing the basics. You have learned the basic of a bullish candle, a bearish candle, and a doji, and the very basic bullish, bearish, and continuation patterns that you can find. There are thousands of them, guys. I promise you there's so many your head will spin. But to get you started, this is what you need to know. We will give you a PFD that you guys can download. I highly suggest that you print out the PFD and attach it to your computer or to wherever you trade, just to have it as a reference while you are still learning these patterns. My last tip for you guys is that as you're journaling your trades throughout the week, if you are using something that is more rule-based where you haven't really gotten into the technical analysis side of things and you haven't really given too much thought to this, that you do actually do that. Start journaling your trades and go back at the end of the week, even with your rule-based strategies. See if there was a pattern that could have helped you, that maybe you identified and were like, wow, I should have actually done a reversal here and not bought there, or oh, there was a continuation, I could have held that trade longer. Those are the things that will help you start to critically think and really hone in on your actual trading skills, where you can start analyzing charts and becoming the most proficient trader that you can be. As always, guys, if you have any questions, please feel free to reach out to us and we will be happy to help you. And thank you for watching. Hello, welcome to the house.
All right, everybody. My name is Artie, creator of the Moving Average YouTube channel. And in this lesson, I'm going to teach you pretty much everything that you need to know about Heikin Ashi candles. We're going to go over the structure of the candles, the signals that it provides for you, and the use cases for these Heikin Ashi candles. So let's get into it. So before we get into the structure of a Heikin Ashi candle, I want to cover bars as well as Japanese candles for you. Each one of these has a 4-part structure: the opening price, the highest price, the lowest price, and the closing price. For a bullish candle, that candle is going to be green or whatever color that you want, but the opening price is always going to be lower than the closing price, thus signifying a bullish candle. Then on the opposite end, a bearish candle or a down candle has the opening above the closing price with a high and a low. The most common candles used are going to be Japanese candles. They have the exact same structure except they are filled in. So you have the open, high, low, and close. What usually happens during the course of this candle is it opens right here. It may drop down a little bit, but then it starts going up, creating a shadow or wick, and then closing a little bit below that at the closing price. These prices that it opens, close, the high point, and the low point are always fixed points. They are the actual true price at which this candle opened and closed. When it comes to Heikin Ashi candles, however, it is a bit different. The formula has been changed. So you shouldn't really concern yourself with memorizing this formula. I just want to give you a brief overview of how these candles are structured. So depending on what time frame you're looking at, Heikin Ashi candles is a Japanese term. Heikin Ashi means average bar. So it's taking a big average of each bar. The high point of every single candle is the maximum number of either the high, the open, or the closing price. The low is the minimum of the low, open, or closing price, whichever is the lowest or the highest. The opening price is 1/2 of the open of the previous period plus the close of the previous period. So it takes an average between those two and divides it in half. The close is 1/4 of the opening price plus the highest price plus the lowest price plus the closing price. Again, let me reiterate, you do not need to memorize this. You just need to understand that the actual close, open, low, and high prices are averages of what the price actually is. So when you get into a trade, it's not going to be exactly as the candle shows. Now, let's give you an example on the charts and show you exactly what I'm talking about. So just to give you a quick rundown of how these different charts look, this is your typical line chart that you would see on any 24-hour news channel. On the top of Trading View, you are allowed to change the candle type right here. The next one we're going to look at is bars. So as you can see here, you have the opening notch, the closing notch, the high, and the low price. Now, looking at that exact same example, the reason why Japanese candles are much more popular is because they are easier to see. It is less straining on the eye. It shows you the exact same information as the bars, but it's just more full. You have the open, the high, the low, and the close on a bearish candle, and on a bullish candle, you have the open, close, high, and low. Now, what I'd like to do here is draw up horizontal and vertical lines to show you this exact candle in the Heikin Ashi version. So we have the open, we have the close, we have the high point, and we have the low point. Now I'm going to draw a vertical line here to signify that this is the specific candle that we're looking at. As you can see here on the right-hand side of the screen, these are the actual prices of the high, low, open, and close. They will remain static. So now that we're looking at Heikin Ashi candles, just so that you can see the wick better, I'm going to put an arrow pointing at this candle. This is the one that we want to focus on. So I'm going to remove this vertical line. And as you can see here, the top of the candle right here is different than the prices that we have here on the side. The only price that is exact is going to be this low point because it is a bearish candle. So this is the open, close, high, and low. So why is this important? Because if you get in to your trade in a short position at the close of this candle, which would look like this, the actual close of that candle's price was 0.71753, whereas with the Heikin Ashi candles, it shows 0.7178, which is a difference of 3.5 pips. You have to keep that in mind, especially if you are trying to scalp using Heikin Ashi candles. So now that you understand the Heikin Ashi candle structure and the formula for figuring out the high, low, open, and close, let's look at how we can use these in our day trading strategies. There are many use cases for this, and it should be used as a tool to supplement your trading, or if you are strictly swing trading, you can use Heikin Ashi candles, but you have to keep in mind that your stop loss is going to be much larger than if you're scalping on a lower time frame. So the use cases go as follows: swing trading, scalping, also giving you a trend shifting signal. I will show you this on the charts of a specific example. Being able to stay in your trade longer, being able to use either ATR bands or Bollinger bands or moving average bands to help you see where this price channel is staying in, as well as seeing concrete reversal indications at key support and resistance levels. So let's get into the charts. I'm going to show you each one of these examples. So the two main benefits of using Heikin Ashi candles is being able to see when the momentum starts at the strongest point of the new trend. Any candles that you see with wicks on the top and the bottom mean less strength in the movement. But when you get a candle in the downwards or upwards direction that does not have a wick, specifically on a bearish candle right here, you can see that there is no wick on the top of this candle. This right here is an extremely bearish indication. Conversely, when you get a candle with no wick on the bottom, that is a very bullish indication. And the last key important indication when it comes to Heikin Ashi candles is this one right here. I've zoomed in a little bit more, and now you can see a very small body with a long wick at the top and a long wick at the bottom. This candle structure right here with Heikin Ashi candles signifies a shift or a change of the current trend. So if you get a signal like this, followed by one of these bearish signals with no wick at the top, the likelihood of a new trend forming is much higher. Whereas if you saw it right here and the trend continued up, you would see that it's just a pause in the current trend. So now that we've covered how the trend shift indication shows up on these charts, now we can look at how Heikin Ashi candles are incredible for swing trading. Essentially, we're waiting for a two confluence setup. You want the shift change indication to show up right here and an indication that the bullish movement will start to go. Entering a long position on your first bullish candle with your stop loss below the swing low, you can clearly see that you're able to stay in a trade for much longer using Heikin Ashi candles, holding the trade until you get that double confluence on the other side, which is that shift change candle plus bearish movement. Now again, this is swing trading, so you're holding a trade for much longer. This is a 2-day trade on a 1-hour time frame. And if you take it out to an even higher time frame like the daily, you can see that Heikin Ashi candles will help you stay in a trade for much longer, because it filters out all of the noise of those opposite candles that keep you closing your trades a little bit too early. 23 days, 616 pips. Now, if you are looking at scalping using Heikin Ashi candles, I want you to draw up your support and resistance levels on a much higher time frame like the hourly, then zoom in to the time frame that you want to trade, like the 5-minute, and you will see once you've had multiple rejections off of a support and resistance level and you get that shift change candle, then your first indication of a large body, bottom wick, no top wick, stop loss above the swing high, you can then target your next zone. Whether you're going for a 1 to 2 risk to reward or whether you're targeting the next support and resistance, it's easiest to stay with a 1 to 2 and or look left and see where price has consolidated or rejected or held support the most. Now that is scalping. This is an 18 pip trade with an 8 pip stop loss on a 5-minute time frame. The one thing that I would like to show you is these monstrous candles with no wick on the top, very large compared to everything else beside it, and a wick on the bottom. These are known as stay in your trade candles. They are extremely bullish or bearish depending on the direction they're going. So as long as you are getting these candles, you can continue to hold your trade. And you can see you did not get a wicking candle until right about here. That was your first wicking candle. So when that candle closed, you would have closed your position right there, taking your 20 pip trade to a 40 pip trade because you were able to see that the trend was very strong and you can hold your trade a little bit longer. You can also use indicators like the Bollinger Bands when it comes to looking at Heikin Ashi candles, because usually when we're very bullish or very bearish, it tends to hug the Bollinger Bands. And then once you get that first indication that the trend is slowing down or stopping, it tends to leave the Bollinger Bands. So that's when you know it may be a good time to get out of your trade, just as another confluence or another reference point. I really hope this lesson was informational for you and you can use all of the information that I gave you to take away to implement in your day trading strategy. Now, when I give you guys specific examples of things, you should take each one of them because each one of them has different use cases. So that means that you can trade any time of day with any strategy if you have a full arsenal of information under your belt. The more information you know, the more information that you memorize is going to suit you better when you are day trading, because each scenario is different and you need to have all of the knowledge to help you trade within each scenario. All right, guys, thank you so much for watching, and we will see you back in the Discord group.